This is King World News. I'm Eric King, and you're about to hear a powerful interview with Bill Laggner, co-founder of Bearing Asset Management. Remember to go to our homepage at www.kingworldnews.com for more interviews, where this week we also have David Tice of the Federated Prudent Bear Fund, as well as Bill Fleckenstein of Fleckenstein Capital. Also, we have part 4 of the Jim Willey Systemic Failure Series. Joining us now is Bill Laggner from Bearing Asset Management, co-founder. Bill, we've had you on before. You were very popular. You've had some extraordinary returns in 2007 and 2008. I think you were up 134% for 08, about 73% in 2007. We're going to get right into this stuff and talk about what's happening in the economy, because we are seeing some type of a bounce in the economy. I think it was expected, in the sense that when you do have massive money printing, you do have a type of stimulation that occurs in the economy. We're starting to have sort of some gambling back in the real estate market again. People are going in and bidding on each other, and we're getting 20, 30 bids on a home, and a $120,000 home isn't even selling for $160,000. It's selling for more in some pockets and in some areas. So let's open with that, Bill. What do you see happening? A little bit of speculation, a little bit of gambling?
Well, it's interesting. You know, we're just about we're about 2 weeks past the anniversary of Lehman Brothers. And at that point, of course, all hell was breaking loose, and the powers that be were running to the scene, creating more credit, backstopping facilities, essentially creating roughly $17 trillion in backstops and bailouts, of which in the last 12 months, Eric, we've spent $3.15 trillion. And what do we have to show for it? We have FHA becoming the new subprime, people going in, buying property with 3% down. These are the same type of people that were participating in the subprime market, bad credit scores, that kind of thing. And essentially, you've got a lot of the transactions taking place, roughly 45% of the real estate transactions taking place the last 90 days, coming within the foreclosure distressed arena. So this could be groups of individual investors. It could be investment funds trying to buy distressed, et cetera. You're always going to get that after a bubble unwinds. I mean, we had this when NASDAQ burst at 5,000 on its way down, people catching falling knives, if you will. But I think it's fair to say that when you look at the amount of capital that was misallocated within the real estate realm in relationship to whether it's population growth or income, or any other metric you want to use, we still have way too much housing within the United States, and prices are continuing, although we've got a bounce here recently, are going to continue to move lower and get to some normal ratio of income in specific communities. And we're not there yet. I mean, Case Shiller has done extensive work here, and actually Amherst Securities was out recently talking about another 7 million homes that will get foreclosed upon over the next several years. So we're through it maybe halfway, but still have a ways to go in terms of a price reversion to the mean.
I agree with you, and the key being the price reversion to the mean. I think on a short-term basis, and this is part of what improves things or gives the facade that things are improving, and then we'll come back to the French and the assignat. I do bring that up from time to time, but it's really important to hammer that point home, Bill. But how things improve, or they look to be improving. When you have these types of transactional revenue streams take place, you actually end up with obviously improved tax revenues, right?
Yeah.
Because as these transactions are taking place, that's going to bring money into state coffers, into county coffers, into the local city coffers. So you end up with a situation where the papers can report, geez, things were here, now they're here, and these deficits that people were so afraid of, well, things surely seem to be going back to normal, and now things seem to be back to where they need to be. It's not sustainable, Bill, you know that, and I know that, but the bottom line is on a short-term basis, it really does give the appearance of a healthy economy moving along where you have deficits shrinking, and very importantly, I think, on these county and local levels and state levels, correct?
Yeah, I think, again, the $3.15 trillion that's actually been spent, of course, there's a whole additional pool of money that can be spent, and you are going to have probably a third quarter GDP number of something like 2.5% as a rough estimate. So for the $3.15 trillion, we've had previous miserable quarters and then one quarter of positive economic growth. But I think it's fair to say that the scorecard that we would give the central planners led by the Fed, led by the current administration, is a failure. It's not helping the real economy. In fact, we could discuss some of the metrics regarding the real economy. The real economy continues to stumble. Money center banks are continually receiving benefits from the government. Those money center banks are incredibly insolvent and have very little wherewithal to lend money to the real economy. So we're just not really attacking the problems. And sure, we could spend several more $1 trillion next quarter and potentially keep the economy from going negative. But your point about sustainable economic activity, there's very little in the way of policy that would benefit something like that.
Well, two key points that you were bringing up there, the insolvency of the banks, and we talk about this a lot on the show, but the fact that the banks' balance sheets are phony, that the fact that normally this would be criminal fraud and that it's being encouraged by the government and basically aided and abetted by the government because they don't want to really tell the world our whole banking system's insolvent. I think that the world has probably picked up on that, but you have to paint a pretty picture, right? Because underlying is the dollar and some of these other things. So there's the insolvency of the banks and the inability to lend. But underneath all that, too, the banks in some ways are actually forced to now, Bill, still lend money to people who shouldn't be getting loans, correct? And they can come in with, say, 3% down or so, have bad credit, and still buy homes, and the banks are forced to do this, or they're penalized, are they not?
Yeah, it's strange because we have really, like Japan post-1990 bubble burst, we have a zombie banking system led by the money center banks. We have a zombie consumer base. Let's face it, the consumer is desperately trying to repair the balance sheet by force. Of late, as consumer credit continues to contract, bankruptcies, foreclosures. The foreclosure data for Q3 came out today, up 23% year over year. So the market, from a consumer standpoint, is trying to delever and actually has begun to delever. Consumer credit, biggest drop in history the last several months. The government is trying to fight this, I should say, by trying to keep credit flowing into areas that are being subsidized, i.e. the FHA with regards to housing. The FHA was a small book of business, maybe $250 billion in business several years ago. Today we're talking about $1 trillion book of business. So you could see what's happening. So the private sector mortgage market is just being absorbed by the government, and this is going to, have its own set of unintended consequences years down the road as FHA undergoes a bailout and restructuring, but that could be as much as 12, 24 months out.
Well, the other thing is on these bidding wars, what are they taking in the end, Bill? They take the cash deals, right? Because that way there's a bad loan off the books for somebody. There's money that comes in to the banking system, and that money really comes from an individual who had that money saved, right? So there's sort of this game going on right now of really it's a massive attempt at reliquefying the banking system through anyway. Charge people ungodly rates on credit cards, hit them with all kinds of penalties, fees, unreasonable anything. Go out and basically, like the mob, just get money any way you can. Be an earner.
Yeah, it's interesting. So the money center banks that were the scoundrels that created a lot of this mess are actually able to go to the Fed window, post very questionable collateral, in fact, collateral that we're all searching desperately to uncover, and then borrow money at basically nothing and then lend it back out to various pieces of the economy. The pieces of the economy that are actually seeing the activity are the pieces that are actually subsidized by the federal government, housing in particular. This is a very short-term attempt to try and create activity, tax revenue, as you alluded to, and confidence. This is all a confidence game. And what's happening is they're fighting this because the consumer, like an alcoholic that's been drinking on bottle for years and years and years, tries to kick the habit. The government is distorting the marketplace and not really allowing the consumer to clean up his act or the drunk to clean up his act. They just keep bringing the bottle of booze back to the same alcoholic, and it makes it tough. But ultimately, asset prices continue to revert to the mean, and we will purge a lot of this excess. Unfortunately, it's going to be stretched out over a period of time.
The other key point that you were making earlier, Bill, was the lack of sustainability.